abandoned crisis that has gripped China's property market.
This is really the big concern throughout all of the kind of crackdown, is whether or not we're going to see financial instability.
If China's economy stumbles, the global implications will be far-reaching. The way the world deals with Beijing may be in for a lot of rethinking.
China has a massive debt problem. And when you have a huge debt problem, when someone's extremely indebted, cutting rates on a future loan that they're never going to take is worthless, right? I mean, when you think about the scale of China's debt problem, their bank assets, that's how many loans they have, 54 trillion at the end of 2020.
Look at the headlines about China's economy, and you'll see a story of a deep crisis. A property market in freefall, wiping out the savings of millions. Unprecedented tariffs from the United States designed to cripple its export machine. Ghost cities and mountains of debt. By all conventional logic, the world's second largest economy should be stumbling. And yet, it hasn't. For the past few years, China has performed a stunning economic magic trick. Despite a relentless storm of bad news, the engine of its economy has kept running. But today, the magic is starting to wear off. The illusion is fading, and the deep fundamental cracks in China's economic model are becoming impossible to ignore. What is really happening inside the Chinese economy? How did it defy gravity for so long? And are we about to witness the bill for its high-stakes gamble finally coming due? Today, we're going deep into the numbers to unravel the great paradox of China's economy. And stick around until the end, because a major geopolitical event is unfolding in Beijing that shows exactly where China's priorities lie. Before we get there, if you enjoy our videos, please take a second to like the video, subscribe, and share for the algorithm to promote to everyone. To understand China's bizarre resilience, you first need to understand the heart of its recent crisis, the property market. For decades, real estate was the engine of Chinese growth. It was massive, accounting for nearly a third of the entire economy when you include all related industries. But this was an engine running on borrowed time and, more importantly, borrowed money. Developers built and built, fueled by staggering levels of debt, creating a market driven by speculation, not real demand. It's estimated that nearly 1 in 4 apartments in China is empty. In late 2020, Beijing saw the bubble was about to burst and decided to act. They implemented a strict policy known as the 3 Red Lines. This policy was designed to force property developers to get their finances in order by setting strict limits on their debt. For heavily indebted giants like Evergrande and Country Garden, it was a death sentence. Financing dried up, construction sites fell silent, and the entire sector, once a primary driver of growth, stalled and then collapsed. Logically, this should have sent the entire economy into a nosedive. When a sector that makes up 30% of your GDP implodes, the shockwaves should be catastrophic. But that's not what happened. And the reason why reveals the unique and deeply imbalanced nature of China's economic system. Every economy is made up of a few key ingredients: household consumption, that's you and me buying things, government spending, business investment, and net exports, the value of what you sell to the world, minus what you buy. In most developed economies, household consumption is the biggest piece of the pie, typically making up around 60% of GDP. But in China, the picture is completely upside down. Household consumption was only 39% of its GDP. That number has barely budged, far below the global average. This isn't an accident. It's the result of policies designed to keep wages relatively low, which makes Chinese exports cheaper and more competitive on the world stage. So, if people aren't spending, what is driving the economy? The answer is investment. Investment made up a colossal 41% of China's GDP, compared to a global average of just 23%. For a long time, this was China's superpower. It built roads, railways, and factories at a speed the world had never seen. When the property market collapsed, local governments, under immense pressure from the central government to hit ambitious GDP growth targets, simply found a new place to pour the money. Investment was redirected away from housing and into 2 key areas: infrastructure and, crucially, high-tech manufacturing. China made a high-stakes bet that emerging sectors like electric vehicles, solar panels, and semiconductors could replace the crumbling property engine, and for a while, this pivot seemed to be working brilliantly. Investment in high-tech manufacturing and services saw robust growth. But this created a new, massive problem. China was now producing a mountain of goods, but its own people weren't buying them because of weak domestic demand. So, what do you do with the surplus? You sell it abroad. This is where the second part of China's resilience comes in. Just as its property market was imploding, it was also facing unprecedented tariffs from the Trump administration aimed at starting a trade war. Exports to the US did indeed cut, but again, China pivoted. Chinese producers aggressively redirected their exports to other markets. Shipments to Southeast Asia surged, and exports to the European Union grew. ASEAN has now overtaken the EU and the US to become China's largest trading partner. By cutting prices and finding new customers, China's export machine kept humming, propping up its GDP growth. So, to recap, a devastating property collapse was papered over by a massive surge in manufacturing investment. The goods from these new factories, which couldn't be sold at home, were then sold at competitive prices to the rest of the world, sidestepping US tariffs. It was a strategy of breathtaking ambition, but it was also completely unsustainable. You can't force the world to absorb your overproduction forever. Eventually, something has to give. And in recent months, we've seen exactly that. The first sign of trouble was a series of brutal price wars. In industries where China had invested heavily, like electric vehicles and solar panels, a glut of supply led to fierce competition, eroding profits for everyone. This overproduction is a key driver behind a growing crisis of deflation. That's when prices consistently fall. While falling prices might sound good to us as consumers, for an economy, it can be a death spiral. It discourages spending and investment, as everyone waits for prices to fall even further. And critically, it makes debt much harder to manage. And China has a monumental amount of debt. Total debt has now ballooned to over 300% of its GDP. Deflation increases the real value of that debt, forcing companies and local governments to spend more on servicing their loans, leaving less for investment and spending. Now, the economic engine is sputtering. The adrenaline shot of redirected investment is wearing off. Recent data paints a worrying picture. Growth in manufacturing and infrastructure investment has declined sharply. Industrial production and corporate investment are also dropping significantly. Recently, industrial output growth slowed, and Vixtaza investment sharply missed expectations. And what about the Chinese consumer, who was supposed to be the key to rebalancing the economy? They're pulling back. Retail sales growth has lost momentum, a clear sign of weak domestic demand and collapsing consumer confidence. With all other engines failing, the economy is once again staring at its original problem, the property crisis. After a brief period of stabilization, urban home prices have resumed their downward trend. New home prices in China's major cities fell again, marking the 25th straight month of contraction. Despite government support measures, the slump continues, weighing heavily on economic growth. China has reached a dead end. Its old model of relying on excessive investment and exports is no longer viable. The strategy of simply pushing more and more supply onto the world market has created deflation at home and trade tensions abroad. The only sustainable path forward is to tackle its fundamental imbalance. It must boost household consumption. It needs to put more money into the pockets of its own citizens and encourage them to spend. This means shifting away from an economic model that prioritizes production and exports towards one that values domestic demand. Doing this would be a monumental undertaking. It would require deep structural reforms to increase wages and strengthen the social safety net, giving people the confidence to spend rather than save. But the benefits could be enormous. A stronger consumer base in China would not only create more stable, balanced growth at home, but would also reduce trade tensions globally. A China that buys more from the rest of the world is a much more stable partner in the global economy. China's leaders know this. They have been talking about rebalancing for over 2 decades. But the short-term allure of hitting GDP targets through state-led investment has always won out. Now, they may be out of road. The choice is no longer between the easy path and the hard path. It's between a painful, necessary transformation and a long period of stagnation and decline. And as China grapples with these immense economic challenges, a powerful political statement was made in Beijing. In a rare international appearance, North Korean leader Kim Jong-un joined Russian President Vladimir Putin to attend a massive military parade hosted by Xi Jinping. The event, commemorating the 80th anniversary of the end of World War II, was China's largest ever military display. Analysts see this as a carefully choreographed show of unity among 3 of America's most potent adversaries, an axis of upheaval defying the Western-led global order. As President Xi declared that China was unstoppable, the presence of Kim and Putin sent a clear message. While its economy faces a moment of truth, Beijing is making it clear that its geopolitical ambitions are grander and more confrontational than ever. The world is watching to see which gamble China pursues more aggressively, the difficult path of economic reform at home or the defiant posture on the world stage. The consequences of that choice will shape the 21st century for all of us. What do you think is the biggest challenge facing China's economy? Can it successfully shift to a consumption-driven model? Let me know in the comments below. And if you found this breakdown useful, make sure to like and subscribe for more deep dives into the global economy. Thanks for watching.